Hello and welcome to another episode of VCC TV. I have with me a very special guest today, MK Sinha, Managing Partner and CEO of IDFC Alternatives. MK, thank you for talking to VC Circle and welcome to the show. My first question to you is that you raised 644 million as first close of your second infrastructure fund, and that fundraising comes at a time when the environment is so challenging for fundraising. How did you manage to do that? Give us an on-the-ground sense of what LPs are talking about in India.
We had a very focused fundraising strategy. I think we basically went to our existing LPs in Fund 1 and a bunch of large LPs who are looking to invest in infrastructure in India. If you look at the macroeconomics, India is the single largest opportunity for infrastructure investments across the world.
Sure.
Right? And the Western world is aging. They have a lot of pension liabilities for which they need to find annuity cash flows. And investing in Indian infrastructure assets ensures a long-term annuity cash flow for that kind of liability profile. So, we basically focused on LPs who had that requirement and LPs who were familiar with us as a manager. So fortunately, we started fundraising in January. It's been 8 months. We've been successful. Substantial amount of re-ups from LPs who have been with us in Fund 1. And fortunately, we have earned our credentials with them, and they did re-up. And we have a bunch of other LPs who find the Indian infrastructure opportunity compelling. And as IDFC, we have a brand presence in infrastructure investing. And therefore, they have committed to us.
But tell me about the kind of perception that India has right now, especially to the foreign world, that we are going through structural problems, infrastructure went through a deep trough. Were you also faced with such similar questions or challenges when you sort of raised fundraising? I'm sure you have come out successfully on that. Yeah. But what were the LPs' questions in this regard?
Yeah, no, so LPs absolutely are concerned about the infrastructure investment climate in India, and therefore they are not overly enthused with investing in construction and development kind of opportunities. But if you look at the current climate, there is a stock of operating assets that's available because we as a country have invested about $500 billion in the last 5 years, and these assets are operational. The developers have a pipeline of other construction and development assets for which they have taken debt, and therefore they are in an over-leveraged position. They are not in a position to raise further equity to correct their capital structure. So the only way they can correct their capital structure is by shedding their operating assets. That is the opportunity that we've articulated as the investment opportunity for our LPs. And that is a strategy with which our LPs are comfortable with. They are not very excited about construction and developmental opportunities unless the government sorts out issues with respect to land acquisition, environmental clearances, coal block allocation, NHAI dispute resolution. There are a whole host of issues which prevent a lot of interested investors from putting their money to work. So we're really addressing the shallow end of the market, which is low risk, more certain returns, rather than and correcting the capital structure of stressed developers who are shedding good assets but stressed developers. There's a lot more money that can come to India for infrastructure investments if we sort out some of these issues, which are not. These are not structural issues. These are issues which are very easily fixable by way of a government intervention.
Sure. You also mentioned that a lot of your LPs re-upped in the second fund. That shows a huge affirmation from your LPs. So how has your exit track record been for the first fund?
So we are the only fund that has actually consistently distributed capital right from year one. On an average, we've distributed 5% of our outstanding capital every year for the past 4 to 5 years. And that's a combination of dividends, certain recapitalizations, and certain partial monetizations. So we have 3 opportunities in which we've had partial monetization: an urban infrastructure sector, one in the port sector, and one in the road sector. So, just a combination of all that has reaffirmed the faith of our LPs who have re-upped.
Your fundraising also comes at a time when LPs are not necessarily so happy with the private equity experience in India. When we talk to them, most of them say that they're not even seeing, distributions coming back to them.
Yeah.
What is your view there in that direction?
Like I pointed out, every year we've made distributions. We've also followed a disciplined investment strategy. We closed our first fund in 2008. In the very first year, we put 45% of our capital to work. And that was a time of market dislocation where people were not putting a lot of capital to work. From 2009 to 2011, I think the public markets were irrationally exuberant. We saw the public market valuations at 2 to 3 times what we were valuing infrastructure assets at. And so we just stayed away from the market. And in the past year and a half, there has been market dislocation again, but there has been a reluctance by the promoters to sell their assets at the right value. So, we've been selectively picking up assets, but the stress has now become even more acute. We think over the next 2 years, distressed promoters will be forced to sell good assets. And fortunately, we again have the money to put to work at the time of market dislocation. Times of market dislocation is the best time to be investing.
Can you just give us sort of some kind of indication that how much you return to your LPs, like 1x or 2x of the capital?
So, the partial exits that we've had is in the range of 2x. The other distributions that we've had is by way of dividends, which is just regular cash flow, like excess cash after servicing debt, and recapitalizations. Again, recapitalizations, we haven't followed a strategy where we've just recapitalized on the backs of an easy debt financing environment. We've recapitalized on the backs of transition from an operating phase to a construction, from a construction phase to an operating phase.
Okay.
So that's, that's the kind of recapitalization that we've utilized to take some money off the table as equity.
How should one approach fundraising in this market?
There is no one size fits all, right? I think it depends on what you're raising money for. The private equity world is different from the infrastructure world, is different from the real estate world. As IDFC, we are raising capital in real estate, we're raising capital in infrastructure, and we will shortly be raising capital for our private equity fund. So for infrastructure, I think we've articulated a very focused investment strategy, which is appropriate for this time. Where there's, like I said, market dislocation, leveraged sponsors, good assets available to be able to correct the capital structure of the sponsors. Real estate, for example, we are raising a core strategy fund. We are not looking at, again, construction, development, and real estate. We're looking at buying, fully developed, constructed, partially occupied buildings. So the only risk we are willing to take in our real estate fundraise is the tenancy risk, which we think, again, is a risk that we can live with, because Indian GDP will grow, the services sector will grow, these buildings will fill up. And, it's an opportune time to be raising funds for real estate. If you look at high cap rates, increasing tenancies, again, developers with their backs to the wall cannot sustain holding on to these assets. Interest rates at an all-time high, and therefore, over time, interest rates will drop, will create value for equity. Lease rentals are on the rise after 2009. It saw the bottom in 2008, 2009. So again, that's, you articulate a strategy for fundraise around that concept. So there is a concept around infrastructure, there's a concept around real estate, and there's a different concept for private equity. Again, private equity is a much broader canvas. So you need to have a focused fundraising strategy. Now, I can't tell you what our private equity fundraising strategy is going to be because we haven't launched a... We are looking at a domestic fundraise right now for private equity. The global markets for private equity, Indian private equity, is not very conducive.
Because of the past experience of the PE fund managers, you think?
Because of, that's one of the factors. It's also a time where a lot of the growth equity investors want to sit back and see how things pan out. Because Infrastructure is a 15-year investment horizon. There is a view that India will be on a positive track in 15 years. Private equity is a 5-year horizon. A 5-year is a lot less certain for India than 15 years. In 15 years, there's a view that we are short on infrastructure, we will build infrastructure.
There'll be annuity income.
There will be annuity income. Private equity is a shorter time frame, and therefore people do not want to rush into private equty in this vintage.
Which is why you took the view to raise money domestically.
We have taken the view to raise money domestically right now, and at some point.
And that will be as big as your infrastructure
No,
fund.
it's going to be much more modest, much smaller, because private equity is not such a sizable opportunity. I mean, you can't be raising $1 billion for private equity. We would look to raise, and domestically we will look to raise maybe 5 to 750 crores.
750 crores.
500 to 750 crores.
From domestic market, essentially.
From domestic market.
Institutions or retail investors?
No, institutions. I don't think we're going to go down to the retail market. Private equity is not a retail product.
You think India is a bad word outside? What is your sense there?
India per se is not a bad word. I mean, I think most investors have what I would call cautious optimism about India. So, I think India does not have any structural problems. I mean, well, you can say the structural problem is with respect to our external account. But we have a pretty robust domestic economy which will, see growth over the next, 15, 20 years. All the issues that are causing concern are issues that can be fixed in the next 6 to 12 months, maybe 24 months. It takes time to fix issues in a multi-party, dysfunctional democracy in India. Now, it is what it is. You have to call it as it is, right? It's difficult for the government to build consensus in a multi-party coalition, format. I think, hopefully we will get it right over the next 12 to 24 months, and we will again see a secular, growth pattern in India. So I think most investors are just waiting for that period of uncertainty to pass. Otherwise, are optimistic about India.
Any kind of difference in fundraising that you saw from 2008 to as of now, or any kind of difference in strategy that we see from your end?
Huge difference. I mean, in 2008, India was the darling of the world, and there was a lot of tailwinds. And now what we're experiencing is a huge headwind. So, in fact, that is a problem. In fact, because you have to have a balanced view on India. I alluded to irrational exuberance in the public markets, where people were seeing which we as educated infrastructure investors on the ground did not see, and people were overtly optimistic, and currently people are overtly pessimistic. I think in India you have to have a balanced view of the economy. You have to have a view over 3 to 5 years. You cannot develop a overly optimistic or overly pessimistic view based on the current situation. But if you look at 3 to 5 year time horizons, India moves in the right direction.
China has been so famous for its infrastructure sort of excellence. There's maglev and everything there. Can we sort of ever catch up with China in terms of infrastructure investing? What are the things that really concern you when you're heading an institution like this in terms of infrastructure? And do you feel challenged by the government?
I think it's not appropriate to compare ourselves with the Chinese market. It's a very different market. It's a very different political environment in China. I think my sense is the banks are not necessarily prudent about lending in China, and that's because they have the government willing to backstop their banks. So they at one level are overbuilding their infrastructure. Maybe that is the right model to follow, provided you have more capital than you need, and you can overbuild, and growth then follows. In India, our strategy has been to build infrastructure to cater to the growth that has already happened.
It's true.
And therefore, I think it's a more robust model financially, because you see the growth, you see that infrastructure is required, and then you put capital to work. Unfortunately, like I said, we have a multi-party democracy. We have coalition governments. There are conflicting agendas, and that slows down, execution of infrastructure in India. So it's two very different markets. But I think in the absolute sense, if we fix some of our issues, I think India is a more robust market than China.
You're also raising a co-investment pool to invest alongside your LPs. Does that mean there's a huge amount of appetite from your LPs to invest in infrastructure investing, and how is that sort of coming along?
Yeah, I mean, that's basically reflective of the trend in the private equity world. I think the private equity world is moving away from large commingled pools of discretionary capital that GPs invest in or invest from, to managed accounts. And what we see in this iteration of our infrastructure fundraise is an intermediate scenario where we do have a large commingled discretionary pool of capital from LPs to manage, but the LPs are also interested in putting their own money to work directly. And that is the co-investment pool. These LPs are large pension funds, sovereign wealth funds, who want to put large amounts of capital to work, which they may not necessarily feel comfortable doing through a fund format. Or in a fund format, their share of the investment is not as large as they would like it to be. So for good assets, most of these kind of LPs negotiate a co-investment framework where they can put more capital to work.
How should one play out the power and road transportation sort of sector, in this market? A lot of money has gone into power, not necessarily seen coming back, especially on the private equity side.
If you look at some of the investments that we've made, these investments were in the construction stage of power plants. All these power plants are commissioned. Now, I wouldn't say that they are doing fine, because there are issues in the power sector with respect to linkage coal, with respect to commissioning of the captive coal mine because of environmental issues and clearance issues. But again, these issues will be fixed. We are making progress. All our power plants are commissioned and operational, and we will see value 2 to 3 years down the road. So again, it's not right to judge the quality of the investment by the current scenario. You have to have the foresight to see the scenario 3 to 4 years down the road. And 3 to 4 years down the road, if the investments that you've made are operational, have the fundamental parameters taken care of, as in coal blocks, evacuation line, and have commissioned, like I said, I mean, there's going to be shortage of power plants 2 to 3 years down the road, and that's when tariffs. There's an increase in tariffs. We've underwritten these assets that 3 rupees. If you look at the current bids, they are more in the 450 to 5 rupee range. So increased tariffs, increased replacement cost of these assets, shortage of these assets will create value. I think we are very confident that we will generate decent returns from our Fund 1 portfolio.
Any sort of thoughts of sort of bundling up assets and then listing them? Can't that be a viable strategy to put liquidity to your investors? Any thoughts there?
Yeah, no. So I mean, in the infrastructure investment opportunity in a private equity format, where you have a hard stop date of 10 or 12 years, it does create its own challenges with respect to investing at the SPV level with the need for liquidity. And we worked on one of the strategies is bundling up the assets into an annuity stream. But that's not the only strategy. There are aggregation strategies with a controlling stake. That forms a company 2 to 3 years down the road. We are executing on that in the road sector. There is, flip options into a listed company. So those kind of strategies to ensure liquidity for our investors is something that we've articulated going into every investment in our fund one.
What is the sense of corporate governance that you can give us dealing with promoters in India?
I think if there is one thing that we need to worry about, that is it. Fortunately, our partners have been all generally good. And there are, again, there's a few bad apples in every portfolio. But that is what worries us the most, because it's some of the promoter groups take a very short-term view of getting rich quick rather than a long-term view of developing a business, which could get them a lot richer for a lot longer time with a lot less stress. But there's always a few bad apples, and I think if there is one thing that we are worried about, it is governance. So we we will continue to watch out for that aspect. I think we are not going to be investing certainly out of our fund two with any new groups. We are going to be investing with groups where IDFC has an existing relationship, with groups that we've had a positive relationship from an equity perspective, with groups that have created value for other investors. Those are the kind of groups we will invest with. In Fund 1, we were not focused so much on that aspect of it. We were more focused on diversifying across assets and diversifying across promoters. I think Fund 2, we will be a lot more concentrated and focused, both in terms of promoter groups that we will deal with and assets that we will invest in.
So you're becoming mature as an investor as you go by.
I would say so, yeah, I think.
Give us 2 or 3 challenges that you've sort of faced as you're building out IDFC franchise in India. Sort of you're building all the 3 platforms, real estate, infrastructure, and private equity.
I think there's challenges with respect to the current sentiment prevailing in India. I mean, to be able to set up a multi-asset class franchise at this time is not necessarily easy. There are challenges in building a culture in the organization which is consistent across different groups, because the way we operate is each asset class has a separate set of people because of conflict issues and so on and so forth. So building a culture which binds all the investment professionals together, keeping them motivated, because the times to celebrate are times like this where we've raised an infrastructure fund, or times where we've had exits. Going into an investment is easy. The proof of the pudding is in the exit, right? I mean, you don't want to be what you call Abhimanyu, right? You get into the Chakravyuh and don't know how to exit. That's the easiest trap that you can fall into. So while we are excited about making investments, I think we are a lot more excited about exits and raising funds. So keeping people motivated, because exits right now, for example, in the private equity world has been difficult. And in infrastructure, it's a long-term investment proposition.
So what is your biggest concern? Is it private equity or infrastructure or real estate amongst the 3 platforms? I think it looks like more private equity as of this time.
Well, I don't say private equity is a concern right now. I mean, private equity, we're going to see a bit of a slowdown because the global fundraising environment isn't conducive. The exit environment is not conducive. But then that's the nature of private equity. You have one strong wave and, things can all start looking very good very quickly.
So how are you building this? Real estate, $2 billion in assets under management, infrastructure, $3 billion. Is there like a view there that you have to build it that big? I'm sure there is,
No, obviously you want to build a platform that has a large pool of capital to manage, but we also want it to be diversified. I mean, so that's why we have a multi-asset class platform. We may add other asset classes going forward.
Like?
Well, I mean, I guess it's something that we will have to think through. I don't think we figured out which one right now. We have our hands full with the real estate fundraise and potential domestic private equity fundraise. Once we've done that successfully, that's when we will begin to worry about adding other asset classes.
Okay, right now you are $3 billion under management.
Yeah, with this first close, we get to about $2.8 billion. We will certainly get to about $3.1, $3.2 billion by the end of this year, because we will have a second and hopefully a final close for our infrastructure fund. We're hoping that we would raise about $300 to $500 million for real estate, hopefully by March of next year. So by the end of this fiscal, my hope is that we will be about $3.5, $3.6 billion of assets under management. Private equity, like I said, it's going to be a domestic fundraise. If it's 500 to 750 crores, that's only $100 million. So I think we are well positioned as an infrastructure investor to go into other geographies potentially, which are not currently being addressed. Measuring yourself in terms of AUM is not necessarily the right thing to do. I think you need to measure yourself in terms of how quickly you have churned capital, how much money you've made for your LPs, and in the process you get rich too.